You've got a trust, but how should it be taxed? There are several options, and today we're going to talk about what it means when a trust is a grantor trust for income tax purposes. Hi, I'm John Strohmeyer with Strohmeyer Law, where we help our clients leave no unfinished business. While I am a lawyer, I am not your lawyer, so don't take the advice from some talking head on the internet. Make sure you get your own advice from your own advisors about your particular situation. Now, today we're talking about what happens when we're going to pay income tax when it comes out of a trust, when a trust is involved. There are some options. Things are more complicated because trusts pay tax in a different way than individuals, corporations, partnerships, and other taxable entities. So we want to get into what the real option is when we're thinking about estate planning. The option that you may not be aware of is called grantor trust status. And what happens generally is when a trust is taxed as a grantor trust, some individual other than the trustee of the trust is taxed, meaning they're paying the income tax and not the trustee. This allows the trust assets to grow without having to pay income tax. Why? That grantor is paying the tax instead. So, what are we thinking about? Well, again, this is an income tax issue, and that's to be compared with a federal estate tax issue. A lot of times when we put assets into a trust, we're doing it so that we can avoid future estate tax. But because grantor trust status has to deal with the income tax payments and how the trust is going to pay income tax on what it receives, well, it's separate. And so it's possible to have different results for estate tax and for income tax. So you can have a trust that will be subject to estate tax when a person dies. It's going to be fully includable. So it's possible to have a trust that is subject fully to estate tax when the person dies, and the grantor of the trust is going to pay all the income tax. That's going to look like a revocable management trust. A second option is to have a trust that's exempt from estate tax when somebody dies, and the trustee is paying the income tax on it when they're still around. So this would be a normal complex trust. Finally, though, we've got a completed gift trust where somebody's given assets away and then somebody else, not the trustee, is responsible for reporting and paying tax on the income and gains and deductions and all the rest that comes out of that trust, meaning the trust grows without having to pay income tax because somebody else is paying it. Now, how do we get this? Well, first thing, we need to figure out who that grantor is. And if we look in the Internal Revenue Code, we're going to be looking at sections 673, 74, 75, 76, 78, 7, and 78 for how those trusts get set up. Now, each of these code sections will provide a different reason for why a trust may be treated as a grantor trust. Why were they doing this? Well, years ago, the income tax rates, so back in the 1920s, the income tax rates on trusts were much lower than they were on individuals specifically. So what would happen is people would put assets into trusts, but hold on to the beneficial interest, hold on to certain powers so that they could still get the benefit of those assets, but then the trust would be paying lower income tax rates. Congress didn't like this, so they added the grantor trust rules to say if you've got a trust that's set up this way where you've given assets away, but actually you're still holding on to the benefit, we're still going to tax you, the individual, on the gains inside of that trust. Basically, you're not going to be able to take advantage of those lower income tax rates on trusts by setting up a trust. Now, fast forward about 100 years, the rates on trusts, the income tax rates on trusts are much higher. And because they are, people don't really want to pay those higher income tax rates. And so we set up trusts as grantor trusts, one, to get lower income tax rates. Whoever the grantor is going to pay tax at their rate. But also, it allows us to leverage gifts because the gifts are growing free of income tax. So, what are those powers? Under Internal Revenue Code Section 673, reversionary interest. Basically, if somebody is given something into a trust, but they can ultimately get it back, if it can revert back to them, that's a way to trigger grantor trust status. Internal Revenue Code 674, controlling beneficial ownership. So if you've put something in and you get to say who may be the beneficiary later, that's going to trigger grantor trust status. 675, if the person has certain administrative powers over the trust. They retain the ability to do certain things, control decisions made by the trustee. Well, they still have that control, and Congress thought they should still be taxed on what's going on in there. Internal Code Section 676. If the grantor has the power to revoke the trust, well, if they can revoke the trust, it's basically still theirs. And because it's still theirs, they should still be taxed on it for income tax purposes. Internal Revenue Code 677, income for the grantor or the grantor's spouse. Now, this shows up where, again, the income's coming back out. Why wouldn't it be taxed to the grantor? That's what Congress was thinking. Finally, Code 678, someone else could possibly be the grantor. And this shows up for beneficiary defective inheritors trusts or BDITs. What you're looking at is somehow a beneficiary is being treated as the grantor of the trust. Because they're being treated as the grantor of the trust, the beneficiary gets taxed, not the trustee, not the grantor. You can only have a beneficiary being taxed as a grantor if none of those other powers under 673 to 677 are being used to tax the grantor of the trust. Which powers get used a lot? Well, under 675 are administrative powers, the swap power for the grantor. So what we'll see is grantor will contribute assets, but they retain the right to swap something of equivalent value. So they can get back what they want, or if they're looking at, well, maybe they're going to pass soon, they have this cash, which is not going to get a basis step up when they die. They can swap it out for low basis assets. So, what are the common powers that get used? Well, the swap power under Internal Revenue Code 675 is the first one we think about. We use this a lot because a grantor can make a gift into a trust and then still retain the ability to swap out assets later. Now, these have to be of equivalent value, but what it means is if a grantor is getting ready to pass away and they have a lot of cash, well, we might want to take advantage of the basis step up at death rules and take low basis assets out of the trust and put cash, which won't benefit from that basis step up, into the trust, basically lowering future capital gains tax after the grantor's died. Another common one, using income from the trust to pay premiums on life insurance on the grantor's life. This comes in under the 677 income for the grantor's life. So if you're putting income or if you're putting assets in a trust, buying income or buying life insurance for someone, doesn't have to be on the grantor, but it does have to be life insurance on the grantor's life, then that can be a reason to trigger grantor status. Under 675, you may be loaning assets or making loans to the grantor. That can trigger grantor trust status. Finally, the ability to add a charitable beneficiary under 674, the controlling beneficial ownership. It's one of the last common powers we see. You can add a charitable beneficiary as a permissible beneficiary of the trust. Now, why? What are we thinking about? Well, one, the reasons to think about this. First, it allows the assets to grow free of income tax. This allows assets to grow faster, have there be more assets for the beneficiaries. What you're also thinking about is the grantor is spending down assets, which may be important for them to lower their future estate tax. Basically, they've got an obligation to pay something because they're obligated to pay that bill. The grantor is spending money on an income tax bill, which means it's going to have to get paid one way or another. Might as well make it for the benefit of the trust beneficiaries. Another thing to think about, if you have the grantor and the trust basically being treated as the same taxpayer, because everything on the grantor trust tax return ends up on the grantor's individual tax return, well, you can engineer sales between the two that aren't going to have any income tax repercussions, but what they will do is get assets out of the grantor's taxable estate. So you can have a sale from the grantor to the trust where you're moving assets. It's not treated as a gift for estate tax purposes. It is respected for estate tax purposes, meaning the grantor moved an asset and its future appreciation out of their estate and gets cash or a note back. But they're not going to be paying any income tax on what has happened. All right, so we've got a grantor who's responsible for all the income tax. What if they get tired of paying the income tax bills? Is there anything we can do about it? Well, yes, there is. Two things. The first and the most common is because these are powers that are given to the grantor that trigger them into being The grantor, for income tax purposes, a lot of cases, you can have them just give up that right. Say, look, I don't need the ability to swap assets anymore. I don't need the power to add charitable beneficiaries, and basically toggle that grantor status off. This happens when people basically say, oh my gosh, there is a huge income tax bill coming and I don't want to pay it anymore. Generally, this is a one and done option for clients. We're not going to have them turning on and then turning back off and then turning back on the income tax grantor status. Basically, one and done. What you worry about is if the IRS sees that you're turning on and then turning back off the income tax status, they may say it doesn't really matter and we're just going to find what they like. And if you can avoid that fight with the IRS, that's what you should be doing. Another option is to include a tax reimbursement clause for the benefit of the grantor. So the grantor is going to gift assets into the trust, but then tell the trustee in the trust agreement, hey, if I get a tax bill, you're still allowed to make tax distributions back out to me, so I'm not hit as hard with that future tax bill. Now, the IRS has looked at this recently. There's a lot of talk about whether or not this should be treated as a gift. Is that reducing the size of the gift? That's going to be beyond what we're thinking about today. Personally, I don't like tax reimbursement clauses because I think it does get a little too close to not making a real gift. Frankly, if a grantor is going to gift something into a trust, they should be waving goodbye to it. They should not expect to have the taxes come back to them. If you're going to be the grantor until it's not time to be the grantor anymore. You can shut off the grantor trust status, but don't pretend that you're going to go back and forth. I think it's just too dangerous. The IRS is probably going to be upset that you're whipsawing them. One last thought before we close out. Under Internal Revenue Code 678, it is possible for somebody other than the grantor of the trust to be taxed as the grantor. Generally, these are going to be beneficiary defective inheritors trusts, BDITs, sometimes called, where the beneficiary is the taxpayer. While we talked about toggling off or on the grantor status, when you have a situation where the beneficiary has been set up as the grantor, generally it's not going to be possible for them to turn that status off. Once that beneficiary is the grantor under the grantor trust rules, that's it. They're set. The only options really are to either make a distribution to pay for the tax, which is the benefit of being the beneficiary, or to change the investment profile of the assets in the trust so that the beneficiary is no longer getting hit with that tax bill. So there's a lot going on with grantors, beneficiaries, and how they're going to pay income tax when it's coming out of the trusts. Remember to talk to your own advisors. Thanks so much for watching.